first off, Dominic L says, do you foresee any stock opportunities similar to the pandemic? And then any idea as to when the lowest point might be? For us at SCM, we don't pick individual stocks. So there might be, I always tell people recessions and economic disconnects create new opportunities for some creative companies. They're probably out there. As engineers, we've always followed a top-down approach where we believe it's most important to get the direction of the economy and which sectors will perform well during that part of the economic cycle, and then leave the stock picking to the experts, which is why we use a lot of index funds and actively managed mutual funds with that. But as far as the lowest point, now again, this is my subjective opinion. This is not investment advice, but with me personally, I'm 48 years old. I don't plan on touching my retirement for 20 years. So this is me personally, and I have a very average risk tolerance. I had an average risk tolerance when I was 20 years old. So I like balanced portfolios. But me personally, when I look at the markets, I feel like, again, we're going to go below average. So if you look at below average based on earnings, somewhere between 3,000 and 3,300, I personally would look to step in and take more risk. Again, 20-year time horizon, 20 years. I'm not talking about short-term money, 20 years. I'm comfortable adding risk to my account when we're down about 3,000 to 3,300. That's still 8 to 17% down from where we're at today. The second point where I get really excited is somewhere between 2,500 and 2,800. And I say that because that's the PE ratio where bear markets, recessionary bear markets have ended. So again, 20-year time horizon. That's where I would expect the market to go. Now, it may not get there, and I don't have time, maybe if we have more time for questions or if it comes up. I believe it may not get as bad as I think it will yet, because I think things are breaking in our financial system and the Fed may have to reverse course. But if I saw these numbers, I would be getting a little bit more excited about buying stocks. As a moderate investor, 20-year time horizon, keep that in mind, 20 years, not short-term money. That's what I would be looking at. Next question. How often is your team monitoring our accounts, daily, weekly, etc.? And Kim, you're very welcome for us hosting this webinar. I'm glad to do it. Hopefully we don't have to do it again before year end, but we will if we have to. Now, this is our bubble chart, and I added in the coding. Tactical models are in gray, dynamic models are in blue, strategic models are quarterly. They're in red or pink, whatever you want to call that color. Now, tactical models, it says daily underneath, those are our quickest moving models. Especially tactical bond, cornerstone bond, income allocator. You see it over here in the low risk bucket. We're watching that every day. Doesn't mean we're going to trade every day. During a bear market, we typically don't make a lot of trades. We have had some bad trades with tactical bond, but that's the nature of it. The data says it looks to be a tradable low. We get in. If it's wrong, we get back out and we take our lumps and we keep that cash ready to redeploy it. That's just how it's worked going on 30 plus years now with these models. The dynamics, we only look at those once a month because that's when we get all the economic data. So at the first week of every month, we pull in all of our economic data, determine what the model says. Right now, it still says bearish, so we invest accordingly. Now, the strategic models say quarterly. One thing to understand, that's the core of the portfolios on the strategic models. We have a trend allocation in there and I'll use the growth model just because it's easiest to understand. The goal of the growth model is to be 100% invested. And then we have two trend indicators that if they go bearish, they sell. So at the first one, we went to 85% stocks. And at the second one, we went to 70. And that's where we sit today. Now, those models update every week. So it's quarterly with an asterisk in that we look at the trend models every week. We don't necessarily have to wait for a big rally. We are not yet there, but there's an oversold, which means a level. If it gets so oversold at the end of a week, and then we start to see things stabilize, we could actually get back in with half of that allocation. So we'd be back to 85% on a weekly basis. We don't have to wait till the end of the quarter. So hopefully in general, Tactical short-term stuff is looked at daily. Dynamics, which is more intermediate term, looks at monthly. And then the strategic models, the core adjusts quarterly, but we actually look at it every single week. Next question, Michael K. Do you honestly think increasing rates any further will do anything but make economic conditions worse? So, as a basically career-long critic of the Federal Reserve, I'll say absolutely not. I think raising interest rates is going to make things worse. And I will also say the Federal Reserve has no choice because they created this mess, not solely by themselves. Congress obviously dumped 3 rounds of stimulus in there. We had both political parties voting yes on that. We had 2 presidents from 2 different parties sign those bills to dump all that money into the economy. And they both knew they were giving too much money to people who didn't need it. So back to interest rates, though. That caused a whole bunch of growth. And the only way to stop growth as far as the Federal Reserve goes is to slow it down, which will bring down inflation. So they've already said they're probably going to have to cause job losses. They're probably going to have to see an economic slowdown, probably a recession. You've heard it called a hard landing, which the Fed is so aggravating. There's a TikTok video where I said, if the Federal Reserve was honest and we did a little mock press conference, they've been horrible at making predictions, yet everybody trusts the Fed. I don't know why. If you look at inflation, here's where we're at today. And the PCE is what the Fed uses. They don't use CPI. There's a whole bunch of issues with CPI. I could probably do an hour on that. It's, doesn't do you guys any good for me to go through that. But we're seeing inflation decline a little bit as far as how high it is. But here's the thing to keep in mind. The Federal Reserve was targeting 2 to 3% inflation. They never hit it until COVID. And then all of a sudden they went way past it. So the Fed's policies haven't worked for several decades, and yet everybody still trusts the Fed. I just don't get it. Looking out, I keep saying this is what people don't understand is our deficits are long-term deflationary. We can't keep sending money to other countries via our trade deficit, and we can't keep sending money to other people via our budget deficits without causing deflation, because that's stealing from current growth or future growth to try to stimulate current growth. Too many retirees are deflationary. We're in year 3 now of what was going to be a 5-year bubble of baby boomer retirements. So each of the next couple of years, we're going to see more 65-year-olds than the year before. That's deflationary because when you work, you have what's called a money multiplier, and that you're making money and then you're spending it, which creates jobs. Well, when you're no longer making money, you now become a money divisor, so that you're just literally taking money out of the economy, Social Security, pensions, pulling it out of your retirement, whatever. You become a money divisor, and that's deflationary. Excess savings is deflationary. We've seen people, and I think it's a good thing, try to get their balance sheets right. Well, that's actually causing some of the deflation that we'll see coming about, my expectation, late this year, early next year. Increased productivity is deflationary. Our company is one that definitely has seen our productivity increase because we're able to do meetings like this, and I don't have to travel around the country doing them. We don't have to spend money on flights and hotels. You guys can sign paperwork via DocuSign now. It's much more efficient for everybody. That actually causes deflation. Inventory surpluses are deflationary. We're getting some of that now. We see that Nike, Walmart, Target, Kohl's, I lost track how many retailers have said they have too much inventory, and we're about to see massive sales. That's deflationary. That's going to start showing up in inflation numbers. And then it sounds silly to say, but inflation is deflationary. And what we mean by that is people slow down their spending when there's inflation. That causes the economy to turn over and drop. So yes, Michael, I don't think that raising interest rates is going to hurt. What I hate about this is, I talked about this since COVID. We had the K-shaped economy where people who, I call it the laptop economy, if you could work from a laptop, you actually probably were better off during COVID income-wise than you were, because you couldn't spend money. It was embarrassing how much money we had left over when all of a sudden we couldn't go out to eat, or get our nails done or go to the movie theater or whatever it was we were spending money on. I think most people saw a balloon in their bank accounts. But we also saw the bottom half of that economy where they couldn't go to work, they didn't have excess savings, and their income was shut off, which is why we needed those stimulus checks. Well, now inflation is hurting the people who were living paycheck to paycheck back during COVID. And also, what the numbers I'm seeing, like credit card spending is up 13% over the last 6 months. So the people that are being hurt by inflation are putting it on their credit card, and now they're seeing their interest rates jacked up. So the thing I've said about the Federal Reserve for over 20 years is when your only tool is a hammer, everything looks like a nail. So the Fed has always thought, we have this tool of interest rates, and we're going to fight everything with this hammer. And they create bubbles, and then they have to deflate bubbles. And right now they have to deflate this inflationary bubble. I think this was the last prepared question that came in during registration. And then we have, looks like 3 more so far. If you have any more, hit that Q&A button and we'll get to them. Isaac S. Typically, bonds and stocks have opposite correlation. With both bonds and stocks down, which will rise first? I think, and I'll just go ahead and stop sharing that because I didn't have a chart for this, because this is just projections. Again, take this as my subjective yet experienced opinion. I've been doing this for over 25 years. Nobody has been through a period in their careers where we've seen stocks and bonds both going down in value, because the last time that happened was the late 70s. But here's my opinion is the Federal Reserve is going to push things too far, push things into a recession. We're already seeing disconnects in the United Kingdom because interest rates and inflation is much higher than people projected. And a lot of pension funds, and I would guess Wall Street banks, leaned too far, and they started, trying to make more money in a low interest rate environment. And now things are breaking. My guess, and it's a little cynical, but hey, it's happened every financial crisis since 1998. The Federal Reserve is going to have to jump in and bail out Wall Street again. So I apologize if it's, if you're on the West Coast and you're just taking your breakfast, or East Coast, you're having lunch. It makes me sick to say that, but I'm very confident the Federal Reserve is going to have to bail people out. Don't know when. It could be as early as before Thanksgiving, maybe before Christmas, probably for sure when we start getting into a recession next year. And the reason they're going to have to do it is because Wall Street banks got too leveraged, too exposed to derivatives, and the Fed's going to have no choice. That should lead to a bid up in Treasury bonds, and which leads yields to go lower. I would guess, based on past financial crises, it's not going to be a big boost to stocks to change that we're in a bear market. I could be wrong, but we would most likely expect bonds to bottom first. And again, this is my opinion. I feel like we're getting close to the top in long-term interest rates, just because the Fed is pushing us towards that recession. And I think inflation is going to start falling very, very quickly, which then will allow bonds to readjust their prices, because long-term bonds are based on inflation expectations. If inflation expectations drop, the yields can go down, which means prices go up. So to answer Isaac's question, my opinion is bonds are going to bottom first. What we're going to do with our investment accounts is whatever the data says. Dynamic income is still making money as interest rates go up. It's having a great year. It's been a great hedge for all of our income portfolios. Until that model says rates are going to start going down, that's how we're going to be invested. So even though this is my opinion, I don't want you to take that as this is what STM is going to do. I also don't want you to take that as investment advice, because things can get ugly and things can break very quickly. So hopefully that answers the question. Let's jump into some of the other questions. So let's go in order. Somebody says, getting questions about Blackrock and Louisiana, pulling funds from them should we be concerned? And then somebody else is asking about BlackRock. So hold on. Totally unrelated, can be answered last. Can you tell me any information you have about BlackRock? I know that it is listed within my retirement fund, but I've recently heard not so good things about them. Okay. So those are both related to BlackRock. So BlackRock has been in the news about, mainly because of their CEO talking about ESG and how active they are. Now, BlackRock is the largest institutional manager in the world. We have a lot of clients who are federal employees. BlackRock managed your retirement funds in TSP, whether you knew it or not. BlackRock also runs a lot of state retirement funds. They run index funds. However, unlike Vanguard, who could care less about what a company does, BlackRock has started to say, we're going to care about how you're taking care of people. Now, personally, and if you've heard any of my webinars, if you've read my blog over the last 20 years, I believe companies should try to look for all stakeholders. And that's essentially what BlackRock's doing. I disagree with some of the things they're doing, and we don't have time to go into that, but because of one position they've taken, and that's environmental stewardship, where they're wanting companies to look at their carbon footprint and things like that. By the way, the SEC is making companies talk about the impact of climate change, their carbon footprint, and things like that. That's being in the works as well. So the market has always evolved to what people care about. If you care about those things, we have cornerstone portfolios. We can do things like that to worry about that. But with BlackRock specifically, I haven't heard specifically what Louisiana is doing, but I've heard other states talk about it and it would make sense that Louisiana would, is if BlackRock is anti-energy, which they're not. BlackRock's the biggest investor in ExxonMobil and Chevron and everything else because of their index funds. But Louisiana is basically saying, look, this is the lifeblood of our economy. Why would we pay fees to BlackRock? We're going to pull from there. Look, I've talked for 20 years about the problem if the whole world becomes passive investors, and if they only use index funds like BlackRock and Vanguard, we're going to see big price disconnects. I firmly believe that we're shifting more passive investing in index funds is being exposed as dangerous to a lot of people's financial health. And we should probably see BlackRock and Vanguard's assets go down regardless. I don't think it's a concern if your pension plan or your retirement fund is or is not invested in BlackRock, because the rules require you as a fund administrator to have a broad list of investments, and you'll have index funds available. We found that whether you have the subset of funds who might be non-ESG compliant, you're not really going to give up a lot of performance. So I wouldn't get too concerned about that. If you're in an employer plan, you have no real choice anyways. But you're pretty much stuck with BlackRock, Vanguard, TIAA, who is very, very active in the ESG space. And a lot of teachers have no choice but to use TIAA, or state employees have TIAA. So it's behind the scenes stuff, but in general, your employer plan should have lots of index fund choices for you. So Mike asks, for those that are retired and taking a draw on SEM funds, what advice might you have if you're comfortable with the risk profile? He says he has room to draw less, but waiting to see how the economy goes. Definitely, that's a financial planning thing. And in general, what we've found, and financial planning software allows us to do this, is if you lower the volatility in your account, you can actually accept lower returns. And so SEM's fixed income models are designed to allow for 10-ish% drops in your portfolio. We're not there yet. We're down about 7%. And that's because we understand that we can make up a 10% loss very quickly. As far as if you do have flexibility to reduce income, Definitely. You don't want to take out money if you can afford it when things are down, because that means you have less money to make up on the upside. So if you can afford to cut back, and this is just a bear market / recession statement in general, do it, because then you'll have more money to put to work on the upside. Because again, 20-year periods, the market's never been down. Past performance is no guarantee of future results, but we have 96 years of data backing us up on that. So yeah, if you can reduce your income withdrawals, do it. That gives you just more money to work back on the upside. If you can't, again, the financial planning software, we've already modeled 10% losses in the portfolios, and that's easily able to handle most withdrawals, because if the past is any indicator of what comes on the other side of a bear market, we have some huge gains coming on the other side. I don't know when, but that leads us to what so far is our last question, and we have just a few minutes to go. So if you have any more, get them in now. Otherwise, this is going to be it. What's your best guess as to when the impending recession will end? This is the CFA Institute calls it a mosaic approach. I read probably 200 to 300 different research reports a week. We have all of our economic data coming in throughout the week. I have my experience. So my educated guess, and this is all it is a guess, is we may not quite officially be in a recession yet. That might not start until into the fourth quarter, going into January of next year. But if you look at how the economic data starts resetting, I would guess by next summer, we're not in a recession anymore, that we've kind of wiped everything out. Inflation is going to be 4 to 5% next March, down from 8% today. And if we start seeing that slowdown, we could easily see inflation down below 2% by next summer. And with that being the case, I think we're going to be growing from a different base, and who knows what happens then. But that would also line up. Remember, we had the data on how long a recessionary bear market happens. This bear market started in January. 12 months is obviously January 2023. 18 months is June 2023. That would be an average bear market. The problem is that last leg down, when we do officially hit recession, is the scariest for stocks. The last 1/3 down of a bear market is the scariest. So that's one reason we wanted to get this webinar out there today. We very likely will see some sort of a big rally before Christmas. If you're in too risky of a portfolio, that's the time to de-risk it, because we will likely see that last leg down of the bear market, with the asterisks of, if the Federal Reserve has to bail people out, who knows what's going to happen. So hopefully that answers everybody's question. One more, oh my gosh, two more. Will a potential change in government administration help or hurt growth? This is almost like I set this up, Mary, who asked this. If you've seen any of my other webinars, if not, it doesn't matter. The data has always borne this out. We're talking micro differences as far as economic growth and market growth goes between Democrats and Republicans. I always tell people, don't let your ideological beliefs or your political beliefs influence your investment decisions. There is one bad thing economically, and I only speak economically, that could happen, is if the Democrats have full control of everything, and that means they have to get past Manchin and Semina and have, basically 52 votes in Congress. We could see tax hikes coming if the Democrats also have control of the House. So I'll hold my opinion on that. But the way all the polls are shaking out right now, I feel like Congress is not going to be able to do anything to make the economy worse after the election. And then Tony, well, we got 4 minutes left. He says, I'm 63. Should I reduce 401k deductions until this turns around? I'm putting 15% and that to put it in while going down. What do you think? I love dollar cost averaging. For Tony's sake, hopefully you're in some sort of portfolio that isn't 100% in stocks. But in general, for most people, this is the time to be increasing your 401k contributions. Because if you think about it, stocks are 24% lower than they were a year ago. So if you love stocks 24% higher, you should absolutely love them today. And so you're now buying at a discount. That's why we think employer plan contributions are very helpful. Tony, if you don't have an advisor, fill out risk.semwealth.com and we can take a look at your 401k allocation. If not, ask your advisor to make sure it's in line with your financial plan. But in general, you want high contributions right now because stocks are on sale. So that now's not really the time to lower it. For everybody, hopefully you're taking advantage of any employer matches. Those are returns I can't get you because it's depending on the match, it's 50 to 100%. And I will refresh one more time and I think I'll call it there. We're pushing right up against the hour. I'm so thankful for everybody that tuned in. This is, I think, by far our highest attended webinar. If we have to, we'll do another one before the year is over. We'll just kind of gauge based on what our clients are telling us, what people are telling us at conferences. I felt like people are getting nervous, and I don't want you to be too nervous, especially if you're an SCM client. We truly appreciate your hard-earned money, and we don't take it lightly. We know better times are ahead. We planned for this, and we can get through it, and we are so excited for the other side of this. But we also don't want you to get sucked into really negative feelings or losing more money than you can afford, which is why we did this webinar. So stay tuned, scmwealth.com. There's a subscribe button on the blog if you're not getting our weekly updates. Follow us on all the social media channels. You'll get links to everything that we're doing. And most of all, enjoy fall. It's a nice crisp day here in Virginia, and get out there and just enjoy life, because there's a lot more important things sometimes than your investment accounts. So thank you.